All right. Hello, everyone, and welcome. Looks like we are live. I wanted to first thank you for taking the time to check out the webinar today. My name is Danny Cieniewicz. I'm a CFP professional with Hyperion Financial, and today we are going to be talking about how to best plan your first energy retirement and how to avoid the five most common mistakes that we see. So, what we're going to be covering today, the first thing that you're going to hear is a little bit about us and just kind of why you should be considering these things as you're approaching your retirement. And then we're going to cover into some level of depth the first mistake, which is selecting benefits without the proper research. The second mistake is the impact that taxes can play, and if you don't pay the proper amount of attention to it. The third mistake is not maximizing the 401k plan at First Energy. The fourth is if you're not properly flexing your social security benefits. And the fifth mistake is not reviewing these benefits on an ongoing basis. And then the last thing that we'll cover is how you can best plan ahead to make sure you're able to avoid these and have a retirement that you can enjoy on your terms. So the first thing to cover is just who I am and who we are at Hyperion Financial. So again, as I mentioned, my name's Danny Sinowitz. Alongside, I'm the tall one in the middle there, and then to my right is Tyler Storms. He does the operations on our team, and then to my left is Michael Hartman, and Michael's the one who does a lot of the planning for our First Energy clients. Michael and I both have the CFP professional designation. Michael's also a retirement income certified professional. So between us, we do a lot of work for First Energy clients. We've worked with a number of both current and then retired the First Energy employees as well. And in the 14 years of doing this, we have seen a good bit of information that has popped up. We've seen some commonalities and some differences. Ultimately, though, what we see is folks from First Energy who want to make sure that they live and enjoy retirement on their terms, and that's what we're most focused on. So, we are located in Shillington, Pennsylvania. And again, like I said, we do a lot of virtual work though as well for employees of First Energy, kind of all throughout the map. So, one thing to cover before we really dive in though is a disclaimer. So, the information that we're going to provide tonight is educational. It's meant as a guide to assist you in financial planning. Any specific examples that you see are just for illustrative purposes only. They're not representations of specific investments or guarantees of future returns. Please make sure you're consulting with your professional for specific questions regarding your particular situation. If there's any error or inconsistency that you see between the document and the official plan documents, make sure that you understand that your company plan documents will govern. And then also another disclaimer is that this document represents the views and opinions of Hyperion Financial and has not been reviewed or endorsed by First Energy or any of its employees. So let's get into the problems that retirees are facing, but also First Energy employees are facing as well. So the first one you may be aware of, and it's a good problem, but a problem nonetheless, it's that Americans are living longer. So a recent study done by the Society of Actuaries, who really their job is to study life expectancy, they found that for a healthy married couple who are both age 65, there's a 50-50 chance that one of them will be surviving into their 90s. So that tells us that for folks that are in good health, at age 65, that we may need to plan for a 25 to a 30 plus year retirement. So it's not something that is just for a couple of years here. It's a significant amount of time that we need to make sure that we're properly planning for. And another problem that we're seeing that First Energy folks have is, again, maybe something that's a good problem, but still a problem is higher income usually leads to higher taxes. So, one of the great benefits that First Energy offers, which we're going to cover in a minute here, is the pension plan. And if you've been taking advantage of the 401k plan and a Social Security benefit, those income figures can lead to some tax bills coming in retirement, which is a lot different than just the income that you've been able to make through your earned income at work. So making sure that you understand how the taxes work. If you don't properly understand it, you could be in a position where you have to pay a hefty tax bill, and no one wants to have to pay any more to the IRS or to their state government than they have to. And then another thing is making sure that you know how to coordinate three different sources of income as opposed to just one source of income. So your first energy salary that you're making, you may have a good feel for how that works, how the taxes work, withholdings, any contributions you may be making. But something that's going to change come retirement is you go from making your salary to potentially three or potentially more different sources of income between Social Security, your 401k, or your retirement savings, and then also your first energy pension. So making sure you understand how each of those sources of income work with the dynamics that go along with them is of utmost importance. And then the last thing that you want to understand too is that if you're able to properly plan, you're able to kind of remove maybe some of the stress that comes with the finances. And that's really what we see the most successful employees or former employees. That's the common trend is they've done the work ahead of time. They've planned ahead of time for a retirement that allows them to do so on their own terms. So let's get into it. What's the first mistake that we see that's a common mistake for FirstEnergy employees, both current and future retirees? The first one is that they select benefit options without doing the proper amount of research, and this could be a problem for a couple of reasons. But one that we see as a common one is that they haven't done the right job of choosing the right spousal option. So you may find when it comes to your pension benefit, there are a litany of different options that you can choose from, all meaning different things. There's definitely some commonality amongst them, but what we want to understand is that you do have different options that would be available to you. To make sure that we're doing the proper research, though, what we want to always know is the health of both the employee and the employee's spouse, because that's going to dictate. I think that's one of the main factors that dictate which option you should choose. Another factor that you should be considering is the age differential between you and your spouse. So, if you have a spouse who is significantly younger, and then you want to also make sure that they're not disinherited, that's going to affect your pension benefit if you choose an option that would just cover your life or cover both you and your spouse's life. And then the other thing that we want to consider is, has the spouse also saved for retirement? Does the spouse also have a pension plan? What's the spouse's social security benefit? All these factors can really help us come up with a plan that makes sense, and then a benefit option that makes sense for the employee to choose. That way, they're able to choose an option that they're able to both maximize how much they're able to make, but also make sure that they're not disinheriting a spouse. The second thing that we see is the retirement date and the planning when it comes to choosing a retirement date. Again, it's going to take a little bit of research on the front end, but one thing that we see is if you're no longer working at First Energy, the pension benefit will stop growing at age 60. So if you're no longer working there, that age 60 it's an important number to understand. If you continue working beyond age 60 at First Energy, you will see it that the pension benefit will continue to grow. But what we want to make sure of, though, is that if you're no longer working there after age 60, you don't want to just continue to delay that benefit, which is a common misconception because it works a little bit differently than Social Security would. If you delay Social Security benefits, you could see an increase. But when it comes to the pension with First Energy, if you're no longer working after the age of 60, there's really not that delay, the benefit in delaying, which is something that you want to make sure that you take into account. So why this matters and some things that you should be considering. The first one again that we mentioned is the choosing the right spousal option and making sure that you have a plan for both you and your spouse in retirement. If you improperly plan, you could be leaving dollars on the table that First Energy would basically be recouping instead of you. Or if you improperly plan, you could unfortunately be disinheriting a spouse who may not have saved enough money in their own end, or if there's again a significant age difference. You want to make sure that you're choosing an option that works best for you and your family situation. There's no universal right answer, as we see when it comes to choosing a pension option, but making sure that you're planning ahead to understand which option is the best one. That's the best strategy you can go forward with. Another thing that we want to make sure of is that you're intentional about your retirement date. Um, we see it all the time where folks are ready to move on to the next stage of life, where they enjoy maybe their time that they had at First Energy, but they're ready to move into the beach house. They're ready to spend time with their grandkids. They're ready to get on the golf course or on the pickleball court. So, in order to do that efficiently, though, we want to make sure that, again, you're planning ahead. Give yourselves some time. Sometimes months just aren't enough. You want to give yourself a year or two in advance to make sure that the retirement date that you're setting makes sense. But choosing a retirement date that again you can make sure that you're maximizing your benefit as opposed to just choosing a random date without understanding what the implications are of that. Another thing that you really need to make sure that you are why you are doing the proper amount of planning of this is these decisions in almost every case are irreversible. So again, you'll see a lot of different options on your statement of the different pension options that are available to you. You want to make sure that you're choosing an option that makes sense for you and your family. And obviously things can change, but you don't want to be choosing something that may not make sense for both you and your family, you and your spouse as you're choosing this option. You want to make sure that you've done the prep work ahead of time and that the option that you're choosing makes the most sense moving forward. The second mistake that we see is one, unfortunately, that not a lot of people are aware of, especially while they're working, and it's the impact of taxes and not paying the proper amount of attention to it. Improper tax planning can lead to some hefty bills come retirement in your retirement years here. Specifically speaking, what you're going to find is that retirement and investment income are going to be taxed differently than earned income would be. So while you may have a good feel or may have a good understanding of how your current salary is taxed and your current tax situation exists while you're working, when you transition to retirement, it's going to be taxed differently, and that could create some great opportunities for you. You may not be making as much from a taxable income standpoint, and that could open up some great tax planning opportunities. Things that are available to you, such as Roth conversions, which you may have heard of, or some capital gains planning. But if you're able to take advantage of some of these things or plan ahead for them, it can limit the amount that you're not just paying in a given year of tax, but also across your lifetime. Our goal is to see you work with your tax professional to limit how much you're paying in a given year, but also over the course of a 25 to 30-year retirement. The less you pay to the IRS, we consider that a win. Another problem that we sometimes see folks run into is that they're not aware of some of the penalties that exist within their accounts. So, for example, withdrawing your 401k too soon, if you haven't reached the age of 59 and a half and haven't met all the other criteria the IRS lays out for a qualified distribution, you could be subject to a 10% penalty. And again, no one wants to be paying any more than they have to the IRS. So making sure that you're aware that you're following the tax rules when it comes to your retirement it becomes vitally important. And again, why this matters, what you should be considering, uh, as we talked about, the first one is that earned income is going to be taxed differently than your retirement income would be or your investment income would be. So you can actually strategize and be intentional about how much you're paying in tax each and every year. And the way that you can do that is again by taking control of your taxable situation and your income situation, and by strategizing accordingly, you can pay less tax in a given year but also over the course of your lifetime. So understanding how those rules work and those strategies that are involved can really put you in the driver's seat and not the IRS when it comes to paying your taxes. Again, pretty simply put, it's if you understand the rules of how withdrawals work on your retirement dollars, on your qualified dollars, you're going to find that you can avoid penalties. But if you're not aware of how the rules work, it could cost you in penalties, which again is your hard-earned savings that are going to go to the IRS when they really don't need to. And then one thing that we found is one of the best plans that folks can put together is certainly a diversified plan. You may hear that pretty frequently when it comes to your investments, making sure that you're diversified. But arguably more important is to make sure that you're tax diversified as well. Taxes are usually one of the highest line items that most folks will pay in a given year, and certainly over the course of their lifetime. So making sure that you have a proper mix of pre-tax and post-tax sources of income that you can draw on can really again put you in control and make sure that you're not paying any more in tax than you have to. You're paying your fair share and no more. So again, it's really important to make sure that you're working with a team of both your tax preparer, but also someone who's looking at future tax projections for you. And it's a great opportunity that FirstEnergy employees have if you do the work up front. Let's talk through the third mistake that we see, and it's sometimes the surprisingly can be a forgotten piece of the retirement puzzle, which is the 401k plan. So for many employees, the 401k plan is really their retirement savings, but for First Energy employees, sometimes it can be forgotten behind the pension and social security that are out there. But a 401k plan can really supercharge your retirement income if used properly. The one thing that we sometimes see for retiree or for current employees and future retirees is that they leave their plan on autopilot. Maybe they set a couple of investments. Maybe they're not paying as much attention to some of the investments within their plan. And as a result, you could be allocated incorrectly. You could be missing out on gains, or you could be leaving yourself subject to risk. You could also be paying more in fees to some of these funds than you should be. So, by analyzing this and making sure that you have a plan that is suited to your risk tolerance, and also with investments that are not overly expensive, that can make sure that you're maximizing the benefits within your 401k plan. But specifically at First Energy, what we also see is we want to make sure that that the folks that we're working with, the employees, are taking full advantage of the match. So if you contribute 6%, you can get that 3% match, which again is free money from First Energy. So by you saving in their 401k plan, you're able to get some additional dollars there from the company. A great benefit that's out there, in addition to the pension that First Energy is going to provide to you. If you're over the age of 50, which if you're watching this, you more than likely are. You also should be aware of how the catch-up provisions work through IRS guidelines. So each year, those numbers typically will increase. But as you get closer to retirement, if you're able to put a little bit extra away, it can help you on both a pre-tax contribution standpoint to lower your taxable liability that given year. But again, also just kind of give you that extra padding inside your 401k account to really again supplement a retirement for you that you're able to take advantage of. Again, why this matters is if you can combine the 401k plan plus the pension plan and a great social security strategy, you certainly can be well on your way to a retirement that is envious maybe amongst other folks that don't work at First Energy. We see, if you're able to take advantage of all three of these things and save in a tax efficient way, but also save in a way that minimizes some of the expenses within the plan and is allocated properly, can really put a plan in place that you'll be hopefully very satisfied with. Again, understanding how the annual contribution limits work. Again, each year, the IRS will release the guidelines for the following year, usually towards the end of the year, to let you know how much you can contribute. And if you're able to afford it and you can save those dollars, it's going to help you from a tax perspective. But at a minimum, you got to make sure that you're contributing up to that match to get that 3% from First Energy that they're willing to offer there. Again, that's free money that you'd be leaving on the table if you don't take advantage of that. And then I think in conjunction with, individual retirement accounts that you may have, maybe other brokerage accounts that you may have, a health savings account that you may have, these different types of accounts that you can look to save can really, again, supercharge your retirement. And when the unexpected comes up in retirement, you can make sure that you're equipped to handle it if you're able to properly save and, again, properly diversify from a tax perspective, the different accounts that are out there. The fourth mistake that we often see is folks who improperly choose their Social Security benefits, not flexing the Social Security benefits properly. Um, there's some similarities between the pension and Social Security, but obviously some pretty notable differences. But one thing that we see is that folks may improperly choose when to collect Social Security. There are certain ages to consider, kind of the three magic ones would be the age 62, maybe an age 67 full retirement age, or whatever that number is for you, and then age 70. But again, we feel pretty strong that there's no universal right answer of when you should or shouldn't choose. It's based on an individual and a family situation with proper planning. But understanding that in retirement, you have that 401k, you have the pension, you'll also have Social Security. You're going to have freedom and flexibility to make sure that you're maximizing these three benefits. So, again, when you take into consideration there's tax planning that you can look to do, when you take into consideration that you have flexibility in other sources of income that you can be drawing upon, you may be able to wait with Social Security and delay the benefits until a later age, which can be a pretty substantial benefit over time. Each year that you delay your Social Security benefit, that's an 8% guaranteed growth that you can actually see on your monthly income. And I don't know about you, I'm not aware of many products right now that are offering a guaranteed 8% growth. So making sure that you have a strategy in place to maximize those benefits. If you can delay, if you can afford to delay your Social Security benefit, it's a great opportunity to get some guaranteed growth to fight things like inflation, again, which we'll talk about here on the next slide. But much like the pension, Social Security is more than just a you decision, we'll say. It covers you and your spouse. It's a decision that oftentimes people take into account. Well, I have my Social Security and my spouse has his or her Social Security. And what you need to understand is that yes, that may be true, but the decision that you make could also affect your spouse when it comes to collecting a Social Security benefit. For most breadwinners who are earning more than their spouse, if you're able to defer to age 70, you could create a large monthly figure. And if you predecease your spouse, the spouse then can collect that benefit. So the longer that you're able to delay, the spouse may be able to collect on that higher benefit, as opposed to if you chose to elect an earlier option or in an earlier year, it would be a decreased benefit that that spouse would be collecting. So again, these decisions are not universal. We don't just have a yes, you should collect at this age or that age. It is taking into consideration, the age difference, the health of both spouses, and then the retirement savings of spouses, and making sure that you come up with a well researched and a reasoned decision, as opposed to one that maybe you did just based on emotion or based on feeling. Um, if you've been living in the United States or anywhere in the world for that matter over the last couple of years, inflation has been one of the major problems that we've seen across the board, and pretty much everybody has felt it. In the middle class and the lower class especially. But what we want to make sure that you understand is that if you have a plan in place that allows you to defer, a higher Social Security benefit can help take some of that inflation risk off the table. And again, like we referenced in the first slide, or one of the first slides, if you're a healthy 65-year-old and you're married to another healthy 65-year-old, there's a good chance that one of you guys is making it to your 90s, if not beyond that. So as a result, you want to make sure that you have a plan in place that can stretch over a 25 to 30-year time period. And keeping in mind that inflation is definitely going to be one of those problems. $100 today didn't spend like it did 30 years ago. So, we got to make sure that we're taking that into account, projecting into the future as well. And then something that should be considered is, again, Social Security is one spigot among three that you may have. So there's certain things like a Social Security bridge strategy should be taken into account, where maybe you're able to delay that benefit, but if you have a certain income need or a certain income desire that you really want to take advantage of, perhaps looking at your 401k to help supplement some of the income as opposed to using Social Security could come into play. That's something that should at least be considered if you're looking to take Social Security at an earlier age rather than a later one. But regardless of how all this shakes out, you want to just make sure that you and your spouse have done the proper planning, because again, a Social Security decision is usually a pretty big one. It's one that has long term effects for both you and your spouse. The last mistake that we often see, and one that I think that's most unfortunate, is not reviewing the benefits that are available to you each and every single year. FirstEnergy offers, I think, some great benefits to their employees, and I think it's something that the more you know, that the more that you can take advantage of. But one that we see that can be a common mistake amongst pre-retirees, FirstEnergy employees who are approaching retirement, and younger ones for that matter. But one thing that they often run into is that maybe they're in good health, they're not really utilizing their health insurance frequently. As a result, what they can look to do is enroll in a high deductible plan, so saving on premiums from month to month, but also opening up access to a health savings account. And if you're not familiar with a health savings account, it's something that can also offer you a great way to save on a tax advantage way. And FirstEnergy also offers benefits where they will contribute to an HSA each year. $500 if you're on an individual plan, $1,000 if you're on a family plan, which again is if you are enrolled in that type of plan and your health situation dictates that you can be enrolled in that type of plan and you're not taking advantage of that, those are free dollars that you'd be missing out on. So again, you should be looking at what your health insurance options are. But another problem that we often see is folks who neglect to review their beneficiary options from year to year as well. We understand that life dynamics change. Things happen over time for families that may be coming from a divorce situation, families who may be on a second spouse situation, regardless of what it is, or for children for that matter. Making sure that you have your documents and your beneficiaries properly listed is of utmost importance. The last thing that you want to do is leave a mess behind for your heirs that you when it comes to your finances. So it's a simple check, I think, each and every single year to make sure that your beneficiaries on things like your 401k, on things like your HSA, making sure that you have the proper beneficiary information on some of these accounts and on your different accounts that you may have is again of utmost importance to really make sure that you're not leaving a mess behind for your heirs. So again, this matters because changes take place each and every single year, whether that be directly at FirstEnergy, whether that be through the IRS, whether that be at other sources, maybe in your own life, you may find that there are changes taking place. It's worth at least checking annually to make sure that your company benefits match your goals and making sure that they match what you're trying to accomplish. Making sure that you are reviewing your 401k and the investment options, because as you get closer to retirement, you may or may not need to change your allocation. That's something that we want to make sure that our folks, as they get closer to retirement, that they have done that and they have done the due diligence. And that's something, again, we want to help them with. Again, one thing that we often see when it comes to health savings accounts, which I mentioned before, we sometimes hear a client say, well, I don't want to just contribute this money and lose it. And there's a difference between what are called flexible savings accounts or FSAs versus HSAs, which are health savings accounts. And the available option that you have at FirstEnergy, the health savings account, it's a portable account. So you don't lose that amount that you've contributed each year if there's a remaining amount at the end of the year. You can then roll that over to your own HSA. Like there are different things that are available to you through the plan itself if you have an HSA. So making sure that you're aware of how the rules work, making sure you understand that health savings accounts are yours, not the company's. That may, I think, sometimes prompt people to say, well, okay, maybe I should be contributing to this. And then the last thing that you want to keep in mind is that FirstEnergy they offer great benefits that oftentimes aren't advertised or that folks aren't aware of. And just one example of that is if you're enrolled in the supplemental life insurance plan with FirstEnergy, you're eligible to have free estate planning documentation created for you. So if you haven't completed a will, a living will, power of attorney, kind of your basic estate planning documents, which really most people should have those documents. If you haven't been able, or you haven't taken the time to do that, or you're worried about some of the costs with that, if you're enrolled in the supplemental life insurance plan through FirstEnergy, it's a service that's available to you for free. So again, that's one example I think of a couple that you should really be making sure that you're doing the due diligence on and making sure that you're taking advantage to make sure that you and your family are covered for the unforeseen and some things that will eventually take place. So those are the five most common mistakes. But what I want to also just be clear on is that these are far from the only mistakes that we see folks running into. And understand this is covered at a very high level. I think when it comes time to actually planning your retirement, it's going to take some time and effort on your part. But if done properly, you can set yourself up where you don't have to worry about the finances in retirement and certainly the unforeseen factors that may be taking place. So much like your health, if you take good care of yourself, you're going to find that when it comes time to your financial planning, if you properly plan ahead and you're doing the little things right, you're staying disciplined, you'll be able to enjoy retirement and hopefully a long retirement that you may have. Certainly, we understand the amount of work that The folks that we work with, it's not an insignificant amount of time and their life savings that they've been able to accrue. We want to make sure that you're able to maximize that and utilize that in a way that you're able to enjoy it. And really for us, how we operate, as we see it, there's really three options that most folks can and should be looking to do. Um, at a minimum, we think you should be coming up with a plan, whether that's through us or not. Certainly we understand, but the first option that some people do is they do want to take this on their own, and there are some people who have the will to do it, they have the skill to do it, they have the time to do it. They want to take all this on, and by all means, I think it's something that covering these things and avoiding these mistakes. Hopefully, some of this information was valuable to you. If that's the route you want to go. Other folks may have a planner, a financial planner that they work with. Taking some of this information and making sure that their planner is aware of it, and making sure that you advocate on your own behalf with it. The last option is if you don't have a planner, or if you have a planner and you want a second opinion, and you're open to seeing how we work with clients. We really have a three-step process. The first one is we like to gather financial documentation and really showing you kind of through a free assessment some of the different areas in which we see areas of strength, weakness, and concern. And ultimately, that free assessment, we get pretty in depth. We cover things such as your cash flow planning, such as your retirement planning, the investment planning, the insurance planning, the estate planning. Each of these different things we want to make sure that we're looking into, in addition to your company benefits, to make sure that you are doing all the right things, and it matches up with what your goals are. So the biggest thing that we want to focus on is that you are able to achieve your goals, but in order to do so, you need to be taking the actions necessary, and that's what that free assessment will provide will provide to folks. Again, once you have that assessment, what you're free to do is take that and run with it and say, I'm going to implement this on my own, or with my current planner that we have. But really, what we want to then do is, if you do want to work with us, we are then going to get to work on implementing the plan. Again, specifically the areas of weakness or concern, we address those first. But then once the plan has been implemented, or what we've talked about, we understand over the next hopefully 20, 25, 30 years of a relationship together, things are going to change. And when they do, we want to make sure that we're on top of that and proactive. So we have a semi-annual review process. We typically will meet in the spring and the fall with our clients to make sure that they are on track with their goals. And as things change, whether that be on the outside in Washington or whether that be in your own life, that you're able to keep track of the things that are taking place. So those are again our that's our process. I thank you for taking the time. I really appreciate you taking a half hour or so out of your day to pay attention to this. We certainly feel it's important stuff. But to connect with us, I recommend, you may have found this on our website, but check out our website, hyperionfp.com, for more information about who we are, how we work with clients, and what I think is hopefully most valuable is additional resources for FirstEnergy employees and those looking to retire from FirstEnergy. We we have, like I said, we've worked with a number of clients for over 14 years, and I think the experience that we've been able to build in working with some of these FirstEnergy employees, both current and retired, has allowed us to understand how the plans work and really make sure that we're able to help achieve the goals of each of our clients, and making sure that we're on top of things and not letting anything slip through the cracks. You see our office phone number there and my email address there as well. If you have any specific questions or you're interested in that free assessment, please don't hesitate to reach out. We can walk you through what that process looks like and hopefully get you started on what we feel is an exciting time to be looking to prepare for retirement, and again, enjoy the things that you like to do. So with all that said, I'll sign off now, and hope to hear from you. And feel free to provide any feedback as you see fit. So best of luck to you, and hope you have a great rest of your day. Thank you.